First rates will just start coming up on your screen, the Sensex, the Nifty and the Bank Nifty. The breadth is absolutely breathtaking. I mean, it is so amazing that the breadth, irrespective of which way things are moving on the dollar front, on the crude front, it is absolutely breathtaking. Let me now quickly start spotting some names in terms of where the volume action is. Vodafone is coming right up. Grasim's got money. Will it go to Vodafone? No official comment. Markets are speculating. There is price action and constructive price action in Yes Bank, which is up 0.5%. Utkarsh Small Finance Bank trending up on 1.7 million shares. So these are some stocks where I can spot price action. Now the big one, HDFC Bank, has to react to numbers. It is reacting to numbers, 0.5% higher. Then let's look at the price action. You know, the other odd one out which is coming up on my screen in volume and value, I think, is Swan Energy. A large block deal happened, I think, 3, 4, 5 weeks ago. And I'm picking it up only because of the volume action. Another dark horse, we've not spoken about it. Maybe we'll talk about it on Monday, Tuesday. I think it's Jio Finance. I mean, just about everything is moving up. And Jio Finance has got a BlackRock approval to roll out a mutual fund. Why not keep eye on this one for next couple of days? CG Power, UBS and shareholders are saying thank you because the stock has reacted to the report. But Tata Power is where the elevation seems to be coming in. And then you've got Adani Ports where I think the price action is constructive. Hardly a spot of bother, Aisha. I mean, it is absolutely amazing again.
Absolutely. Let's see what IIFL Finance, Global Health, all these stocks as well are up to. There have been initiations from the House of Motilal Oswal. All these stocks holding out well in the green right now. I want to see what a BCL, Gulshan Poly, Balrampur Chini are all up to after the additional incentive for ethanol sourced from grain actually got announced. Gulshan Poly should just come off your screen. That's going to be a more important stock to look out for. 6% of a gap up move is what that stock is seeing. And of course, there is Grasim as well after the rights issue that got announced at a 12% discount to the current market price. That stock is well in focus. What are the realty stars doing after Sobha posting its highest ever quarterly sales numbers and the sales value uptick of a mammoth 37%? Today that stock is correcting a bit. I want to see what Oberoi Realty, DLF, etc. as well are up to, considering the entire sector held out very smartly yesterday. So the gains are still intact on some of those names. There's also RBL Bank, wherein the Q3 deposits have come in higher by 13.5%, an uptick of nearly 20% on the advances as well. So that's another stock which is in focus. There's Lupin, which has got a tentative US FDA approval for one of its tablets. So look out for that as well. Lupin is also in focus. Kalyan Jewellers just came out with its quarterly updates. Very strong show there. And the Q3 consolidated revenue is higher by about 93%. 4% higher for Kalyan. Macrotech Developers also came out with its Q3 update just a short while back before the market opened. That stock also higher by about 2% or so. And actually, it's not bad a start at 21,750 thereabouts, Kunal. Much better than the global handover on a daily basis.
Well, absolutely, yes. And I think this also indicates that this market is going through a follow-through up move. Whenever there is an uptick on the indices, premiums expanding, I think that's again a very healthy sign for the markets as such. And I think, with the texture of the mid caps and small caps looking attractive, that's another positive for the markets overall. So I think the setup seems to be looking very attractive, and it indicates that possibly we may end the week on a much positive note than what we started off at the start of this week.
All right. By the way, a name like Sobha has cooled down after yesterday's ferocious run. You've got a Kalyan Jewellers reacting to its Q3 updates coming in, and a whole host of other stocks that are abuzz within the broader markets like a DCB Bank, IIFL Finance, Finolex Industries and NHPC. Kunal, by the way, what's your first trade?
So that'll be L&T Finance. That's a stock which I've been bullish on earlier, and I think the stock is also inching towards a breakout about that 170-72 mark. So would be looking to buy the stock.
All right, L&T Finance it is. In the meantime, let's hear it out from Rajat Rajgarhia, who we spoke with yesterday. He talks about sectors and stocks that he's bullish on and touches upon the growth trajectory within the PSU sector. Listen in.
At the beginning of this year, 2023, right, I would think that PSUs generally as a theme were starting to, make some buzz. You had defense, you had budget, you had government speeches, you had many indications of railway capex, defense budgets, EMS, renewables coming up, right? So you could have tried to take a stock, buy, sell 4 times in its journey of being 3x. right? If you would have bought a stock at the beginning of that conviction and rode through that entire rally, which is still not over, which is still going to continue for the next few years, right? You could have possibly captured the entire 3x, 5x, right? If you do buy sell because sometime valuation looks high, then the story becomes better. I would think you would capture less than half of the return that your conviction would have delivered it to you. I think the same thing holds true for suppose state-owned banks, right? How many times we have seen 0.5 पे खरीदो और 1 time पे बेच दो, right? I don't think we have seen balance sheets and growth orbit better than this in the last 20 years of these banks. So why should they be constrained by a historical valuation band? Why can't they trade at 1.5, 2 times if they can deliver 16, 17% ROE for the next 3, 4 years? Which means that we are still talking about these stocks that can potentially double from year after doubling last year, right? So I don't think they are anywhere close to a bubble now. I don't think if they rally another 50% this calendar year, they would still be in the bubble. Just that the stories are getting better as the growth orbit becomes better.
But within PSBs, because it is a large enough pool, how do you select? Do you stick by with the leader or do you buy a basket of some?
Look, best of them, State Bank definitely leads from the
Of
front,
course.
right? And I think that the next two you can always bet upon, right? I think this market has so many different categories of investors that the options to pick stocks within PSBs or any other sector is also relevant to the style of the investor who is looking at the names, right? Someone willing to put in $1 billion State Bank is the obvious choice. Someone willing to put 100 crore, you have another second tier, third tier. I won't say second tier, third tier, but the smaller size, right? For retail investors, you can see that the volumes in some of the even smallish PSU banks are, because ultimately all of them are benefiting from the same story. Someone is delivering better than the other. Somewhere the valuation is cheaper than the other. So your core portfolio should have the best, the largest,
Of course.
right? But the market is a combination of all kind of stocks. So I think as a theme, if you like something, you can keep trading in between some and hold core as some.
Sure. So defense, there's PSBs, what else? Where is it that you find there's still value on the table?
I think as a theme, Aisha, we have been very positive on this whole travel and tourism as a space, right? This is again a sector which is just coming up in this country after COVID, right? I would say the last 18 months was the period when this sector started showing its way of leadership on the consumption side. You look at hotels, you look at aviation, you look at travel accessories, right? As the per capita consumption, travel, office travel, leisure travel, entertainment grows, right? There is a huge business opportunity for them.
All right, let's welcome on board Punita Kumar Sinha, who is now joining in on the show. Punita, hi there. Good to have you on board. Wishing you a happy new year. And as we're ushering in the brand new year with elections on the horizon and lots more to look forward to, what do you expect for the year ahead? Are the stars aligned as they were in 2023?
Well, a happy new year to all the viewers. So I think 2024, the beginning of the year, we're seeing much of the same of what we saw in 2023. And I think that momentum, the short-term momentum that we saw in December, I think that's going to continue for a while. But the focus is beginning to shift more towards large caps, in my view. While the momentum in small cap does continue, I think slowly, the value in the large cap is more attractive, and so investors will start looking at that. But of course, this year is going to be focused on elections, geopolitics, and interest rates. And so I think that's the three main drivers that we're going to be seeing the world grappling with.
Punita, what should be a basic strategy for 2024? Conserve capital, take some profits off the table, or just ride the good times?
Well, for the very, very short term, I would say you ride the good times. But I think you've got to become cautious, rather defensive, because there will be lots of news around geopolitics, around interest rates, that will create volatility in the markets. And then elections particularly in the US in the second half. So while the first few months of the year will be focused more on geopolitics and interest rates, I think it's the second half of the year, post-April, where the narrative on US elections is going to take center stage. The interest rates cuts, whether they happen or not, nobody is anyway expecting them to happen in the first quarter of this calendar year, but more likely, in the second half of the year. So that's going to be an important driver in the second half. And then I think right now, of course, the focus should be on geopolitics because the war seems to be getting a little bit heated up. It may come under control or it may escalate. It's hard to say. And then, of course, the tensions in the Red Sea and what that means for supply chain. So I think we need to focus on that. Therefore, I would say more caution would be good, be more defensive, and of course, focus much more on value and the cushion of safety that you need in a market where valuations are, in some sectors, getting a little frothy.
Punita, interesting that you say that. Where is it that you actually find that comfort and cushion in the market to hide behind then?
Well, I mean, to find that comfort more outside India, frankly, than in India. But within India, I think the whole market obviously has re-rated quite substantially. But if you look at the relative valuations, I think large caps in general are more attractively valued as compared to some of the small caps and mid caps. But the momentum is clearly more in the small and mid caps. That's why I think you slowly sort of start moving into areas where there's cushion of safety. I think the PSU basket has some more appealing valuations as compared to the private sector. So I think that's an area potentially that could still see some flows. And I think across sectors, of course, every sector has rallied, some have rallied less. So generally, people are going to look towards laggards if the companies are doing fundamentally okay.
Punita, there is this widespread acknowledgement by everyone that flows will come back into India, as most of the emerging market funds are either neutral or they're marginally overweight India. Given that China is losing its sheen, growth is a concern, policy framework, policy making is a concern, large amount of flows will navigate back from China to India. And that happens, we could look at a situation of where DIs are buying and FIs are buying. Is that a realistic setup scenario for 2024? FIs could come back and they could be buying from both hands.
Well, I actually think slightly differently. I think that China may actually see a recovery, and the flows actually have not been as strong to China as they have been to India. Now, of course, compared to domestic flows, foreign flows have not been as strong. But I think if interest rates in the US get cut and globally, China will benefit. And as I said, there is some valuation cushion there. So I expect that flows into China may possibly increase as opposed to decreasing. And we've seen a little bit of that in December. So while India, has been a beneficiary of outflows from China, India's really been driven by domestic flows. And I think that is not going to change. So I wouldn't worry so much if foreign flows come in a big way or not. And if they do come, that they obviously, because of liquidity reasons, will go more towards the large caps, which is why I'm saying large caps are, relatively better place potentially to perform.
Okay, Punita, great to have you on the show. We'll let you go on that note and have an excellent 2024. I'm sure we'll meet again soon.
Thank you.
Well, the one space which has been on focus of late has really been real estate. That is one sector which has been on a tear. In fact, today as well, some of these names are actually holding out and following through yesterday's rally. Let's welcome on board Pankaj Kumar from Kotak Securities and try and understand what really is going on with this sector. Pankaj, hi, good morning. Good to have you in ET now. Pankaj, the fact that, it's a bright runway for real estate is not quite unknown, but consistently currently you see excellent performance from these stocks. Has the market not already priced in that it's going to be a great next 5 years for realty?
Yeah, good morning. So real estate, if you see the sector was in a downtrend for a very long period between 2012 to 2021. And the last 2 to 3 years, we have seen the volumes picked up. This is largely led by the pent-up demand that we have seen and the consolidation theme that we are seeing in the sector, especially post-RERA. And if you look at the sales volume of the companies, they are at all-time in the Q2, especially our coverage universe. And if you look at the inventory in the system, that is at a lower level. We have 1.5 years of inventory. So that indicates the demand is still strong. And if you look at the sales versus your launches, so sales are more than the launches that we have seen the trend. So looking at the strong launch pipeline that we see in the second half of the current financial year, these companies are expected to do well. And we see the demand is expected to continue for a little longer period.
What is the right way of looking at valuations of real estate stocks? There was a time when we would look at market cap and then land bank. Then everyone said, okay, that's not the right way because ultimately you have to look at cash flow. Now we are talking about P multiples. So as an investor, if one has to judge, and I'm purely talking about investors here, I'm not talking about the real estate sector per se. So how does one judge that this stock is expensive or this stock has still value left?
So, of course, there's a sharp run up in these stocks, and the stocks are now trading above their fair values or near their fair values. We value the stock based on their NAVs, and even on the EV to EBITDA basis on a forward pre-sales, the stocks are trading at say 7 to 10 times, which is on the higher side. Looking at the past trend, so the stocks are of course trading at the higher side vis-a-vis what it used to trade earlier. But we are seeing a strong launch pipeline and the volume surprises are continuing. So we have to look at the results, how it is going to be, and what are the launch pipeline the companies are looking at.
That you're getting then, Pankaj, when it comes to the outlook for the year ahead, because the sense is that perhaps we will see this luxury demand that is prevailing right now only continuing. That demand will continue to remain undeterred going into the next year. Are there select pockets or select cities where you see a pricing advantage taking place?
So, of course, as I stated earlier, also like between 2012 to 2021, the prices were not moving much. And the last 1.5 years, we have seen the prices have moved up. So, if you look at over a longer period, the prices are still attractive. If you look at from last 10 years perspective, price rise in line with the inflation or the cost inflation is something that would not impact the demand. That's what is being expected.
Why is the rural slowdown and the semi-urban slowdown not hitting real estate demand?
So if you look at overall affordability factor, so the affordability factor is still in favor of the most for the sector, and the demand that we see because we are mostly looking at the companies which are listed, and the consolidation theme is there. So and these companies are largely into larger cities, and there we still see the demand are good, and that is not got affected.
To look at buying real estate stocks now, would you be looking at pan-India players? Would you be looking at companies which have a blend of commercial and residential? What should be the best port of call? Because in real estate, there are a variety of companies. There is a Bombay Dyeing, which is a mill becoming a real estate. There is a Century Textile, which is a mill which has become a real estate. There is Lodha, which is Bombay-based focus. There is Prestige, which is coming out of South. बहुत confusion है.
You're right, but if you see, most of the companies are now looking beyond their geographies. So, example like Prestige or say Lodha, they are looking beyond their industry, their core geographies, because the consolidation theme which is happening in the industry, because there is a more preference for towards the branded players, And ideally, we should look at the companies which is having a strong launch pipeline. They are delivering projects as well. And most of the leading names are in that category only.
What about REITs? If one has to choose between REITs and real estate, is REITs a better option? Because you will get some price appreciation and you're getting about a 6% tax-free return. So if you're buying real estate stocks now, the maximum upside is 10 to 12%, which is not risk-free. In REITs, you get a potential upside of 6 to 8%, which is risk-free and tax sufficient.
Yeah. So both are different segments. Of course, on the what we are talking about is the developmental projects, the companies which are into developmental business, and the other category is the REITs, which you rightly pointed out, where we get a fixed kind of returns. So both are different kind of investment basket. So if someone is looking for a very steady kind of returns, then the REIT is an option, of course. On the commercial side, we have seen the occupancies are stable, and now the recent some policies on the SEZ that the denotification of SEZ areas, that is positive for the commercial real estate developers. But this will take some longer time for absorption as well. But of course, both are different from different set of investors.
Pankaj, the other thing is it's not just real estate, but the entire ecosystem that comes with it, right? Especially when it comes to home improvement / home building. Anything out of that you like?
So in the home improvement space, we cover companies in the tiles and the PVC pipe segment, and we've been positive on the names of Supreme Industries and Kajarian.
In terms of looking at the interest rate curve, what is your understanding as to where the interest rate impact will start kicking in?
If you look at the last 1.5 years, the interest rates have been hardening, but that has not been impact on the demand as such. If you look at the rates, still lower than what it was in the previous cycles. And now we are talking about globally the interest rates are near their peak, or it should rather decline over next 1.5 years. So and based on our studies, we see little correlation of interest rate on the overall demand and the performance of these companies that we cover.
Okay, Pankaj, great to have you on the show. Thanks so much for flagging off what's really going on with the Realty Pack. By the way, look at the intraday graph of macro tech developers right now and the kind of surge that you've seen in the stock. That stock will just come up for you on your screens. 7.5% is the kind of move that the stock is seeing. And I think the tick by tick graph will only tell you that it's, seeing a further up move as we speak right now. That's a $90 appreciation nearabouts that the stock is sitting on, already clocking those 4-digit moves as per share. But that said, it's not just realty. Look at HAL after that UBS initiation, 3% higher on HAL as we speak right now. And I think it's already made it to that 2 lakh crore rupee market cap club, if I'm not wrong. We'll just have our research run a check on that. Tata Power is the other one, which is holding higher by 3%. There's HPCL, which is looking very smart. And then M&M Finance as well is quite the mover in trade today. Some of the IT names too are making a comeback. So Wipro, LTIM, Infosys, etc., TCS as well are looking quite decent. And Tata Power, Nikunj, right? We were making the case start of the year as to how this is going to be one of those power stories which will sort of dominate 2024. Also that it didn't do much in the year gone by.
So, Aisha, I look at Tata Power as energy transmission, not just energy utility. See, right now everybody is getting completely blown away with this entire, utility stroke thermal capacity kicking in. So, while the ESG impact is something which markets have started ignoring because excess capacity did not get created because of ESG compliance, everybody is now saying that, okay, ESG concerns are over. But I think, mark my words, ESG concerns will come back. So the future-ready companies are the ones which are actually ready to take a giant leap forward in terms of energy transmission. What is Tata Power doing? Zero expansion in thermal, energy transition, moving into EV, solar, and perhaps moving into power distribution. I think I was reading it somewhere, I think it was Sameer's story or Prakash's story, that they are looking at, between the Delhi-Jaipur highway, they are looking at electrifying the entire highway with EVs. They've already started putting stations out in terms of petrol stations. So Tata Power will be an energy solution provider rather than just a utility, while a NTPC will always be a utility company which will be generating electricity from thermal. Thermal may look right now great because there is a demand supply mismatch, but eventually, look at the pollution in cities. You think India is not going to take stringent steps to bring pollution down? Of course they have to do it. EVs and energy transition are the themes
the
for
answer,
next couple of years now. And everybody who's associated with it, I think, will immensely benefit. In markets, you always see the short-term spikes where disproportionate amount of gains end up and you ignore the reality. But the reality is that if you don't control now, trust me, we'll have to start wearing masks and coming to work. It's getting that bad. I mean, when I was in Delhi for my winter break, my phone said the AQI was 500.
Yeah.
Unheard of.
Yeah.
And you could...
I mean, even Mumbai, for the first time, Delhiites are still used to it for the last, 4 or 5 odd years. Look in Mumbai, there is like, you can see it. The visibility is so poor itself. You can see the smog in the air.
In the morning when I commute, I do cross a patch of racecourse, the Mumbai racecourse, and I looked out and I first thought, okay, wow, fog. Winter is in Bombay. Then I realized, no, sir, it's not fog, it's smog. And that is something which
Ask me when I cross Sea Link, it's a wake-up call.
Yeah, sometimes, those visuals look very appealing until you wake up and realize that it's not quite the pretty picture. Okay, there you have it. We're playing some of those out for
That's
you
of
as
course
well.
Delhi.
That's not, and zero visibility. The AQI continues to remain a huge concern.
There's a flash, guys. There's a flash. Coming from ONGC. Government stake in ONGC could increase by 1 to 1.5% for funding of HPCL green projects. What a coincidence. What a coincidence. What a coincidence that, okay, BPCL and IOC right issue to be halved, may launch right issue in March. Government plans to cut 50%
equity support for state refiners' energy transition projects.
Okay. Government to cut support for energy transition projects, which means that they will have to now migrate towards energy transition. So guys, what we're talking about, the fog, the smog, the pollution, the AQI, all of them is building up to what government wants to do. We'll try and get more details, maybe Prakash online or some researcher online just to, take that news forward, but mark some of these stocks. And we will go to Nitin Agrawal. Good morning, Nitin. How have you been?
Yeah, hi. Thanks. Good morning. I'm doing good. Thank you so much for having me on the show.
Will banks do good in 2024? Everyone has been waiting.
Yes. Yes, the sector performance has been relatively softer, while there have been certain pockets and
exactly.
like PSU banks who have done very well. Some pretty good performance coming in from some of the smaller banks, regional banks. They have done well, but yes, the larger banks, given the concerns around margins, of late the entire developments around the unsecured loans, which is going to clamp down the overall growth, is playing an overhang on the sector performance. And we are also looking at a overall moderation in the earnings growth for the sector versus the sort of a very strong performance over the prior 3 years.
Nitin, I was just looking at data for PSU banks in last 5 years. 5 years is a long time, right? Almost like a world has changed and the outlook has changed for PSBs. The 5-year return for SBI is about 100%. BOB is 94%. Union Bank is 40%. PNB is given 20% return. Okay, granted there is this scam which happened in PNB, but still it is up 20%. So my point here is that while we may look at the last 1 year change in PSBs and say, okay, they've gone up, but the 5-year change means that they still are massive underperformers and they have a long way to go.
Yeah, that's primarily because these banks, they were impacted badly on the corporate cycle. The entire period wherein the AQR was going on, you had seen massive slippages being reported by these banks, and therefore the aggregate losses were running into more than tens of thousands of crores. And now you are seeing that these PSU banks together are close to reaching, like within the 6 banks I'm saying that we cover within the PSU bank space, they are going to hit earnings of close to 120,000, 125,000 crore in FY24. And this will go on to grow at around 17-18% CAGR over the next 2 years. So the change in earnings and the asset quality is massive for these banks. And which is where I think While over the past 5 years, CAGR may not look good, but incrementally, we will see a pretty healthy run rates, given that ROAs and ROEs are still looking quite healthy for these banks.
And in specific, when it comes to the Q3 earnings expectations, do you think that we will see the net interest margins moderating even further, maybe a deposit churn as well, and CASA ratio, a little bit of moderation being seen there?
That's quite likely outcome and something that we are factoring in. Yes, margins have been moderating for the prior 2 quarters, and we expect that trend to continue for the sector. Though for private banks, the pace of moderation will moderate over 2Q. And for PSU banks also, we are expecting a NIM compression in the single digit, because to some extent, the NIMs will be shielded by the MCLR repricing for them. But overall, as you see that the rates are still remaining elevated, certain banks have still increased deposit rates in certain maturities. And going into the busy 4Q, you will see that the fight for deposits will remain intense. Already there has been the ongoing reports about how the CD ratio RBI wants it to be moderated, and many banks are running at elevated CD ratios. So all of this, and along with the requirement that certain banks, private banks, to pick up on the pace of deposits, will keep the deposit rates elevated, which is where the margins will remain one watchful metric over the coming quarters.
Nitin, clearly, the risk reward seems to be more in favor of the smaller PSBs, right? While, of course, SBI and the larger ones need to be part of your core portfolio. But give me some of your stock picks or top ideas from within the PSB space.
Yeah. So we are covering 6 PSU banks. And I think given that the overall asset quality cycle is still going well for the banks, while there could be margin pressure as we talked, but this will get to some extent offset by the upcoming moderation in the cost ratios. Because over last 1 year, these banks have been providing for wage provisions, and this will now come to an end in this fiscal. And which is where you can expect some moderation in cost ratios over the coming 2 years, which along with some further improvement in credit costs will drive earnings. So there are banks like SBI who are very well optimized on credit costs, and they will see some normalization and some increase in credit costs in the coming years. But at the same time, there are other banks, smaller PSBs like say Canara, Union, wherein the net NPA numbers are still higher and they are coming off very sharply every quarter. So which is where we think that some of these small names will do well in both in earnings, and the valuations can re-rate further. And anyhow, the ROEs for these banks are also looking pretty healthy in high teens. So which is going to further drive the returns in these names. So we like names like Canara and Union within the PSBs among the smaller names, I will say. Not exactly small, they know, like the balance sheets are still fairly large for them, but more in context to the larger PSUs like SBI. We prefer Canara, Union, and Bob over there.
What is your view on Kotak independently of the change of guard there? You think markets will wait for at least 3-4 quarters before they get a sense of transition in terms of Mr. Kotak to the new CEO?
So Kotak, this overhang, of course, has been there because it's something very big as a event in the journey of the bank after having taken place after such a long time. And alongside, one will want to see how the business approach or the strategy changes or shapes up under the new CEO, because in last 12 to 18 months, Kotak had been very aggressive in loan growth, especially on the unsecured, how that flows, and how the bank manages the margins, which have increased very sharply over FY23, and supported by the very strong CASA, which has seen some bit of decline in line with the moderation that we have seen for the system. So these factors are going to be important, but relatively, if you see, Kotak still trades at a healthy valuation because the derating that we have seen in banking has happened across. So even other banks, they have derated from the highs that they used to trade, and which is something has happened for Kotak Bank also. But still, relatively, Kotak Bank still trades at a significant premium to the other peer banks. So as we get more clarity around the strategy and on the numbers in terms of margins and the growth, I think one can take a better view. We currently maintain a neutral stance on the stock.
Nitin, great to have you on the show. Thank you so much for taking the time out and joining us today.
Thank you so much.
By the way, let's just want to, bring out some of those oil marketing company names. You just had flashes come in from the wires that the government is actually looking at paring their stake in a few of them. A rights issue for ONGC as well is what was being talked about. Most of these stocks under pressure and have cooled off actually from the gains that they were actually earlier sitting on. The government stake in ONGC could actually rise by 1% to 1.5% for funding HPCL's green projects. And I think there's rights as well, which is being mulled for ONGC. But again, these are sources to wire agencies. So, let's just take cognizance of that. This is not confirmed piece of news that we're bringing out for you. But, since we're on the subject of what's really happening with the entire real estate pack, let's hear out a slice of interaction that Nikunj had with Abhishek Lodha from Macrotech Developers, which, by the way, is one of the phenomenal movers today. And we've already talked about as to how the going is extremely great for the entire realty pack. And here's what he told him about a month and a half back.
We are of the view that we can, keeping our balance sheet very, very conservative, we can grow at 20%, our pre-sales and top line at 20% and deliver 20% ROE. I think if our internal cash flow generations are that strong that we can sustain our 20% growth, then there is no reason for us to add on risk.
Now you guided for pre-sales and 2 quarters, you've achieved 48% of that. The second half, this time we've had Diwali Dussehra, and the second half traditionally is a better half. So can I safely assume that if I put data point, you are on course not only to meet your guidance, but to beat your guidance?
I would say is that, the 20% growth that we promised last year, we of course promised it taking into account, what we felt the year was going to be like, and it looks like the year is on track to meet that guidance.
Is there a volume growth advantage which you have in that 20%?
Yes, of course. Like I said, we like to keep price growth modest, not low and not very high. We like to keep price growth a little below wage growth. So this year, wage growth in the country is going to be around 9%. We are targeting price growth of between 6 to 8%. And therefore, the rest of it is all going to be volume. So we are growing our volumes by about 13-14% this year, partly from existing locations and partly from new locations.
Now, I'm going to ask a question perhaps on behalf of our viewers and your shareholders. Everyone has a different time frame when they're investing in a company. So in 3 years, what they should expect from you, in 5 years, what they should expect from you, and beyond that, I think we'll discuss the next steps.
No, I think short term, medium term, which is the 3 and 5 year sort of timeline that you mentioned. I think what you can expect from us is predictable, low risk, 20% growth in our top line and 20% ROE.
That you can do on this large base also.
Yes.
And keeping the debt to equity under 1.
Means our ceiling that we've set for ourselves is 0.5 times.
All right, let's shift gears then and move on to another corporate voice who's joining in. PTC Industries is in the spotlight with their latest fundraise. Sachin Agarwal is the chairman managing director now joining in. Thank you so much for taking time out. Now, Mr. Agarwal, there has been a preferential issue of about 140 odd crores that you have raised. Tell us a little bit about the marquee investors that have participated and how you're looking to really deploy these funds.
Thank you very much, and a good morning to everyone. Mr. Ashish Kacholia and his firm has joined in this round of fundraise. The primary purpose for us, this fundraise, was to take forward all our investments in the area of metal manufacturing and core technologies related to metal components and titanium superalloys. We have, with this fundraise, now almost reached all fully funded capability for all the projects, which are basically 3 projects. One is our aerospace castings project, the other being aerospace materials project, and the other being last one being aerospace wrought materials, which we have just added for rolling mills and open die forging for titanium and superalloy materials.
Why do you need capital? If you're doing preferential issue, what happens with the fund which comes to the company?
So the funds primarily, as I said, they are all to be deployed in the investment plans that the company has. One of the main reasons to go with this preferential allotment was also because of the kind of investors that are coming in. And we are looking forward for the next 2 years of investment plans. And I think this kind of seals that minor gaps that we've had in terms of financial availability, which were probably, we would have taken some loans, but no, I don't think we would be requiring that much as well.
Are you doing a preferential allotment? Because, you know, the stock's seen a run up and everybody who sees the stock, they say, we don't know how to value this company. The smart guys are valuing future growth right now. But for somebody who is not such a market expert in understanding cycles, they really want to know that where will the growth come from. So at what valuation FY24 or FY25 you've done this preferential allotment?
So as I mentioned in our last discussion, are we not looking at it as a 2-year, 3-year thing? This is a run up to another 6-7 years or a decade of growth. The primary purpose of our company is to achieve parity in terms of capability within the country and put it at par with the rest of the world in the area of metals and metal manufacturing, whatever gaps that are there in the country, which differentiates it from the developing countries, is what we are trying to fill. We are on that path. I think we are almost going to, over a period of next few years, bring the country to par in those capabilities and provide the platform for other equipment manufacturers to not be dependent on supply chains worldwide. At the same time, we are reversing the flow as well. The supply chains that were never existent in the country for these type of capabilities in terms of titanium, superalloys, castings, components, metals, ingots, sheets, plates, these never came out of the country. And because of the current global supply chain crisis created by China +1, as well as the Russia-Ukraine war, all that is going through a shift. And I think we are placed very, very positively, very, very significantly and very strategically in that position to take that gap. And for that reason, there is a huge focus on foreign OEMs. You might have listened, we have got orders from Safran Aircraft Engines, Safran. We have now got various approvals from some of the foreign OEMs, but over the next 1 year or so, we will be getting approvals from many more foreign OEMs. That would put us in a very, very different level, I would say.
How do you see the trajectory moving then beyond FY24? When you say that exciting growth is there, so when these tie-ups, when the order book will start firing in, how do you see the next 3 years different from last 3 years? Could you give us a sense of numbers, or could you give us a sense of your order book? Because that in a sense would be a guidance for our viewers and your shareholders.
So as I said, I cannot provide the guidance right now for the next 2-3 years. What I could say is that, as I mentioned last time, it would be a growth over the next, let's say after 5 years, which would be in multiples of what we are currently in terms of revenue or bottom line. Our EBITDA margins are continuously improving and increasing. We are sitting at almost close to 30% EBITDA margins currently on our existing sales. The businesses that we are adding, what we don't exist. So if you're looking at past, we are only looking at what we have done in the past. The businesses that are added is, let's say, for the entire metals business, where we are setting up a titanium ingot or a titanium mill and a superalloy mill. Now that we have zero revenue right now. That plant is under construction and would go into production next year or early end, next financial year. That itself is a revenue or a top line and a bottom line, which is multiple of what our existing total revenue is. So I think the businesses that are being added because of the strategic position that we have don't really come from doing this growth percent every year, because it will be coming in leaps and bounds. So I think rating it or providing a growth percentage on that, or a 20%, 30% after 2-3 years will not be there, because it will come in kind of chunks after that, once those production lines go up.
All right, good to have you on board. Thank you so much for taking time out and joining in and giving us a sense of that preferential issue. Just a quick check-in on what the rest of the market is up to. By the way, we're quoting at about 21,742 at the current juncture. Pretty smart moves when it comes to the broader end of the universe, which is seeing a gain of about 0.5% plus for the mid and the small cap indices, and lots of stocks that are gaining traction, including the likes of a Phoenix Mills, Spark, Himadri Speciality, Dilip Bilcon, as well as HAL, which is up a solid 3.5%. But time to put the spotlight then on all that's going on within the FMCG space. Let's talk consumption trends for the year ahead, and more importantly, rural recovery, whether or not that's evident. Sunil Duggal is the former CEO at Dabur and now joins in on the show. Thanks so much for taking time out. And, just today with commentary coming in from Dabur as well, talking about that pain that we're seeing in the rural economy. It has been a big concern for FMCG companies for the year gone by. Do you think that there is any respite expected here, or we should moderate our expectations when it comes to rural recovery?
I think we should moderate our expectations in the near run. We have been dreaming of this rural recovery for the last several quarters, and I alluded to this issue that demand may not come back in a hurry when I was last on our channel. And that's exactly what's panned out to be, unfortunately. I think people did think that the rural recovery would be driven by election freebies, etc., good monsoon, and many other triggers. But quite frankly, most of those have not really fructified. There has been very little stimulus given by the government as of now. There were a lot of promises, but not too much delivery. And I don't think there is anything on the horizon which promises in that direction. You will have the main elections coming in the month of May, but given the political situation, I think the whole emphasis on freebies and stimulation of rural demand may be a little bit muted this time, because one party does seem to be in a fairly dominant position. So that again will not really help matters in terms of rural recovery. So all along, there's a fair amount of stress. The margins look good. But keep in mind that we'll be lapping these very favorable margins in the first quarter of next year. So even the margin expansion may look challenging next year. So this is what the scenario looks like. There could be some unexpected moves, both on the upside or downside, which would change the whole planning. But the situation at this point in time doesn't look all that great.
It's not just FMCG, but various other industries as well get impacted with that. Yesterday, we were speaking with a tractor manufacturer, and pretty much the musings were the same. What do you think needs to be done, and is there any hope of a recovery coming in? You'll have election spending kick in. You'll have the budget coming up next, although it's a vote on account. But maybe some announcement to try and prop up the rural end of the economy.
It all depends how seriously the government takes this rural stress. If they see it as a problem which is affecting a very large number of people and causing some kind of stress in their lives, they would open the tap to some extent. On the other hand, they may not have the fiscal freedom to do it in terms of the mounting debt, etc., etc. So I think it's going to be a balancing act between giving some stimulus to the rural market and maintaining fiscal discipline. The headrooms are fairly limited, so I would moderate my expectations. I think at best we could see moderate recovery in terms of top lines. The margins could still be under stress, and if the oil prices now rise, the margins could further dilute. Actually, we're sitting on a pretty good margin profile, but the upsides to that also look a little bit difficult. Now, I'm really talking about the staple side, the mass market, Aam Aadmi products. The discretionary side, a lot of it is doing quite well. So, and urban is doing a little bit better than rural. So there is a dichotomy here. I think the maximum stress point is concentrated in rural India.
If there is stress in rural India, then why is that we don't see deep discounting in FMCG products? Why is that we are not getting this ad which says "Bade sabun pe chota sabun free, 20% more"? None of the FMCG companies are going or dropping prices to generate volume. In fact, they are still protecting their margins.
I think there is a huge tendency not to reduce prices, because then the older price stocks which are on the shelves, you have a responsibility to reimburse the trade on that, and that's a very messy thing, going by my own experience. So what companies normally do is they increase the grammage, and I think if you see SKU after SKU, the grammage increases are quite dramatic, and I think that is a proxy price reduction. Another thing which has happened is that the LUPs, whether it's 1 rupee or 5 rupees or 10 rupees, they have got very embedded in the last couple of years, partly on account of rural stress, partly on account of the whole margin situation easing off a little bit, and that in the long run is not going to be a good thing for FMCG. FMCG companies in India have to break out of this LUP trap and this huge dependence. In some cases, 70-80% of the portfolio mix is on LUPs. And we'll have to find a solution to that. I think we've been struggling with this for the last decade or more, and still haven't been able to get out of this whole rut.
Which we will not talk about as a company. But if you have to buy any other FMCG stock, mine is Dabur. I respect that you were with Dabur. Which is one FMCG stock which you would buy for next 5 years?
Well, let's put it this way. I would buy mainstream large FMCG even now, because I think the valuations have come off a little bit. They're still pretty stretched. But over a long period of time, there's no way that this sector will not grow. So I would buy the large mega companies which play in this space, the Unilever or ITC, etc. I would also buy the brands which play on the discretionary part of the portfolios, the high value, especially food items. And there are a couple of companies. Unfortunately, everybody seems to think the same way. So these discretionary type of consumer companies, the valuation already has gone up quite a bit. But FMCG is a safe play. It may not give you the best returns from the market. It'll give you steady returns. It's probably not a bad time to take a contrarian view about valuations and buy into FMCG. Don't have any near-term 3-month, 6-month expectations on terms of returns. But over the long term, this sector will not let you down. It never has.
Within FMCG, every company is trying to perhaps chart their own course, which is Patanjali, focus on Ayurveda and distribution. You've got ITC, which has become an FMCG company which has deep pockets. You've got Tata Consumer, which is trying to be a food company, from a tea company to a food company. Nestle, they've got finger on their lips. I don't know what they will do in terms of their growth strategy, but they are sticking to the knitting in terms of not going away from food. Who will be the eventual winner? Which category you think will be the high growth category, and if you focus on that category, you in a sense will be rewarded for next 5-7 years?
The food sector probably has the biggest headroom, and I'm talking about higher value food, not the biscuits and the everyday staple stuff, which is pretty well penetrated. But I think people are moving up the value chain into products which offer better experience in terms of flavors, in terms of packaging, etc. So as and when the middle class expands and the lower middle class goes into the middle and higher levels, this area would grow. In terms of personal care, yes, it's pretty well saturated. It's going to be a steady shift, but I don't think there'll be any spectacular moves in personal care. Healthcare is an opportunity which looks very interesting. I'm talking about consumer healthcare, and this is perhaps where the expansion will be the highest off a low base. But this is where self-medication and nutraceuticals, etc., offer a whole lot of opportunities. You will find a plethora of companies coming into this space, the direct-to-consumer, DTC models, etc. But I think the space has barely been tapped. This offers incredible avenues for growth, and I would take a bet on this, but it's very hard to choose which companies will win in this area.
Just open any marketplace, and if I just write chips, there are multiple brands. If I write seeds, there are dozens of brands. If I write vitamin C, there are multiple brands. Distribution has changed and a lot of 20-30 crore brands now are nearing 50 to 100 crore brands now. What does that mean? Because some of the high growth categories which you mentioned are the ones which are getting challenged by the new companies. So do you think the large companies will struggle to make a reasonable dent there because elephants ultimately cannot dance?
You know, the large companies are not very good at, or they are not very experienced in building a DTC models. They are into the traditional distribution systems which work well for them, and those will remain the dominant form of reaching out to the consumer. But it's these very nimble players who are just emerging, and many of them would be, you know, not even 100 crores, but some of them will get it right. And I think there'll be massive attrition here. Maybe 90% of those companies you won't hear of them in a couple of years' time. But the ones who survive, they will be able to build very big and challenging platforms in the DTC space. And maybe, of course, there will be a brick and mortar element too, but these will not be mass distributed, low value kind of products in healthcare. There would be discretionary products catering to a segment of population, maybe largely urban, which has the ability to afford these.
All right, you've given us a 360-degree picture as to how things are shaping up, the consumption trends and outlook ahead. So thank you for taking time out and joining in.
Thank you.
All right, as we slip into a break, ET Now and ET Now Swadesh, in line with helping Indians rise with India, have partnered with Sundaram Mutual to launch Nivesh Day. It's a campaign to help viewers build their personal finance portfolios via disciplined investing. Celebrated today, that's the 5th of every month. So join ET Now and ET Now Swadesh along with Sundaram Mutual to learn how you can build your financial future with an SIP in mutual funds.